This is frightening. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, credit card issuers are now signaling that a major crisis is coming. And when you understand what's going on behind the scenes of these card issuers, it's going to make perfect sense of why they're starting to panic. Because we're not just seeing signs of recession, but an all-out credit crisis. And that's what we're doing in Jackson Hole, Wyoming today, because we have questions and we're trying to catch one of the members of the FOMC board ahead of Jay Powell's speech tomorrow, because for some strange reason, at the center of every credit crisis, this happens to be the Fed. Let's over to the Insider, where we picked today's story up with a headline: the surge in credit card delinquencies might be a harbinger of a coming recession, Wells Fargo says. And this seems almost like an obvious statement. They say might be. Well, how about is? Because if you think about it, when people can't pay their credit card bills anymore, it usually means they don't have any more money. And at the onset of recession, what do we tend to see? A decline in demand, a decline in spending. Well, people can't make payments. Well, certainly they can't buy other things at all. And late payments on credit card balances are rising, and that could be a warning sign of difficult times to come in the U.S. economy, this according to Wells Fargo. Strategists at the bank pointed to credit card delinquencies surging among commercial banks. And for banks outside the top 100 in asset size, late payments on credit card balance hit an all-time high, it said in a note on Tuesday. So here we are hearing from all these experts that the economy in the second half is going to boom, and we're hearing from Wells Fargo says, wait a minute here, we're seeing delinquencies hit all-time highs. Now, two things can't happen at the same time. You can't have a booming economy and people unable to pay their bills. The math on that doesn't work out at all. And so what this starts to tell us is that consumers have been spending way more than they can afford, and just a little bit of a slowdown in the economy has got them in a position where they can't make their payments at all. And here we can see the delinquency rate on credit card loans at all commercial banks. Now, they say it might lead to a recession, but let's take a look at this, because we've got this on a year-on-year rate of change. And I want to note that in 1994, we were entering a soft recession. You can see here delinquency rates rose. We didn't actually have an official recession. That would come later when the dot-com bubble hit. And then again, you can see here delinquency rates, surging positive over that horizontal black line going into the global financial crisis. Then again, you remember in late 2015, going into 2016, there was a global slowdown. Well, that was validated by a rise in delinquency rates, but that was quickly fixed. And now look, we see on a year-over-year rate of change, all-time highs. The question, of course, the Wells Fargo analyst has is maybe this won't be a recession, but in reality, it is going to be. We're going to make the case that it's not just a recession we're facing, it's an all-out credit crisis, one that the banks won't be able to handle. And rising late payments puts more pressure on small to mid-sized banks, according to strategists, during a time when markets have been increasingly concerned about bank stability and rising debt levels in the U.S., which is an understatement, because the banks, there should be no question of their stability. We should never question them. But the fact that they're taking money on a weekly basis, even more money from the Fed's program to keep themselves solvent, tells us that the banking system is just one nudge from going off a cliff. And we're going to find out it's just not one or two banks that are insolvent. It's going to be dozens of banks. And here we can see what the correlation is to delinquency rates, because it all comes back to the banks. It's kind of notable that here Wells Fargo saying, look, these are on the rise. There may be a problem here. And it really all stems back to the banks tightening lending standards. And here you can see we're looking at standards for commercial and industrial loans to firms of all sizes. And again, anywhere you see the blue line above that horizontal black line, on net, banks are tightening standards. So on the way up, they're tightening them faster. On the way down, they're tightening them at a slower rate and against the delinquency rate. So what's notable here is you see banks tighten standards, and then all of a sudden delinquency rates rise. You see that again during the global financial crisis when people were really overly indebted. And now we're seeing it again, which just validates kind of what goes on in this debt-based economy, is that people borrow money that they just can't afford to pay back. And in good times, as long as they can access more and more credit, well, the game continues to play. But as, of course, banks tighten standards, create less money in the economy, extend less credit, well, the whole system starts to break. So Wells Fargo's question of this might be a recession, well, this is a signal of an outright recession coming soon. The economy still has a cash cushion, but we note from the Fed's research reports that's going away quickly. But many consumers are exhausting their credit, as we've kind of pointed out in the past, while income growth has slowed sharply. Our outlook remains for a short, moderate recession and then recovery for most of 2024, likely into 2025, under the notion that this is only going to be a minor hiccup in an uptrend. And strategists at the investment bank have remained bearish on the U.S. economy and stocks. That's because inflation could easily rebound, the bank said in a previous note. But we're going to address both of these in order, because if you look at the delinquency rate on credit card loans, and we've got that again on a year-over-year rate of change against revolving consumer credit. Now, you may remember when that data point came out, it went slightly negative. Now, you can barely see it here, but it did go slightly negative. We're not showing that exactly the same way because we've got it on a change of billions, but it did dip negative. So I want you to see, as people have an increase in delinquencies, what notably happens is the amount of credit they access tends to go down. And you can see that really visibly here during the dot-com bubble. You can see it again during the global financial crisis, and now you see it happening again. So what we can note is, as consumers have less access to credit, that means they spend less. If you spend less, demand goes down. Demand goes down, well, lo and behold, you'll be shocked to find out inflation falls too. And sure enough, if you look at the delinquency rate against the consumer price index, you can see during periods where the delinquency rate is positive, and you'll note the consumer price index flattens out a bit and even can go negative. You'll see it here going to the dot-com bubble. Delinquency rates are rising, and next thing you know, consumer prices are falling. Again, it's just a supply and demand issue. Without the supply of credit, the demand for consumption goes down. And you see it here again during the global financial crisis. You can see that effect even in 2015, 2016. Where inflation sort of moderated, and now it's very obvious. Experts are saying, we're going to hear from Jerome Powell tomorrow, say that he's concerned about inflation rising again. But notably, if consumers are missing payments, well, clearly they're not outspending. And here we see Bullard says re-accelerating U.S. economy could prompt higher rates. And this, again, makes absolutely no sense. But one thing that should be re-accelerating right now, that's your trading count. Let's go back to a previous trade we put on here and showed you, and that was crude oil. Now, you may remember this slide here that our CTA-Timer Pro report that looks at the machine positioning and then runs a second historical overlay, caught this trend here and said you should buy this position here. And if you missed it because you thought, wow, it's a little early, and you waited till here, at the last time we showed you, this was a 15.6 gain. But now we're going to show you how you got out of that trade. Here was the initial signal back on July 3rd. The machines were starting to move into a long position out of a short covering note. And then you can see again on the 7th, this was your kind of last signal that, hey, if you weren't in on the 3rd, 7th, you're all in on this trade. And as the machines are moving long and the price is rising, and now look here, a month and a half later, on August 16th, we get the initial sell signal, and when I ran the numbers, it was a 13% gain in a month and a half. The report is just that easy, can be yours, $30 a month, one trade a year, pays for the whole thing, as you'll soon see. So check that out and get your trading account moving to the upside. Because if you look at what the Fed's thinking, the economy is likely to get weaker, as I think the probabilities are that we are in a new regime that will be a higher interest rate regime. This from Bullard, saying inflation is above target today. Well, obviously, because it was way up to begin with. And he says core inflation is likely to be sticky and come down rather slowly. And without even bothering to put a chart of course, core inflation, it does come down slowly because it's designed to. Once you see things in the core rise, they don't usually come down that much. It's very slow. It moves up slowly. It moves down slowly. So the notion here that we're going to see the core inflation drop to the floor is not going to happen. But headline inflation is indeed coming down because it all, again, comes back to the banks, credit issuance, and delinquencies. And here you can see the net percentage of domestic banks tightening lending standards for commercial and industrial loans to firms of all sizes against the consumer price index. And lo and behold, when banks stop extending credit because they're tightening standards and people can't access it, well, then they can't go out and spend it. And sure enough, what do you see eventually? Inflation starts to moderate, and then it comes back down. You see it during the dot-com bubble. You see it during the global financial crisis, same effect. And we're seeing it now. And you can notably, almost at the same time banks on net started started tightening lending standards, what happened? Inflation peaked and went down. Again, consumers not having access to new credit, and on top of that, then spending down their pandemic stimulus means as soon as that Fed report is right, that of course we're out of that stimulus money and is gone, you're going to see inflation continue to fall and not resurge like Bullard thinks. And here you can see, looking at the yield curve, of course, we talked about at the lead of the show, the Fed seems to be centered at every crisis, even though they act so innocent, because it all stems back to the inverted yield curve. We know that when the Fed artificially forces short-term rates up and the market doesn't buy it, and that's where you see 2-year yields here higher than 10-year yields, that inversion, because banks borrow at the short end of the curve and lend at the long end of the curve, they start tightening lending standards because they just can't make money. They don't want to just do loans at a loss. Next thing you know, credit tightens up, everything starts to fall apart, and you see it happen again here during the dot-com bubble, this little bit, or the global financial crisis, as the inversion led to a tightening of the lending standards and then a recession. And you're seeing it now again. Of course, if you ask the Fed, which we're going to try to get there in the press conference, get some of our questions asked, I have a feeling they're going to kick us out, but nevertheless, again, at center of every crisis, not just a recession, credit crisis, banking crisis, behind the scenes is the actions of the Fed. And now you can see exactly what this means for the broad economy. If you see credit slowing down, well, what should we see as demand slows down? Well, that turns to the factories. And what we saw today, well, another slowdown. As U.S. business equipment orders remains tepid on high interest rates, has nothing to do with high interest rates, everything to do with bank lending. And get this, bookings for all durable goods, items meant to last at least 3 years, slid by the most since April 2020, reflecting fewer bookings for commercial aircraft. Now remember, in March of 2020, we're in the pandemic, so this is the most since then. And excluding transportation equipment, orders rose 0.5%. So look at this, you see kind of the Boeing effect here, minus 5.2% month over month, but this is still not exactly what we're looking for. The figures underscore how high borrowing costs, not so much an issue, stiffer credit terms, there you go, and lingering economic uncertainty are curbing firms' desire to pursue longer-term capital investments. The report showed a decline in bookings for computers and related products, and it also shows a lack of demand from consumers. And again, they keep saying it's an issue of high interest rates. It's really an issue of credit, because in a debt-based economy, higher interest rates aren't an issue if the economy is growing. The access to credits is always the problem. And here you can see the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes against manufacturers' new orders of durable goods. This is the official government data, and we can see as banks tighten lending standards, orders go down. What a surprise, because we know demand goes down, inflation goes down. Of course, orders go down because if delinquencies are rising, people aren't buying. And you see it again in the global financial crisis. And now all you hear is durable goods orders are going to resurge. They're going to head higher. The reality, as long as banks aren't lending, I can tell you the probabilities that durable goods and orders goes down is much higher than if it goes up. And here you can see the evidence of all this coming back to the consumer as Dick's Sporting Goods, Macy's, flash warning signs on the U.S. consumer spending. And the sporting goods chain slashes profit targets for the year after missing Wall Street forecasts for the second quarter. Sales slowed after a pandemic-fueled surge for outdoor gear, leaving it with excess inventory. That's going to be a problem. Inventory levels are high. They're very high. This is going to be an ongoing issue. And executives said theft of merchandise were also higher. Well, what would you expect theft being higher during times when people can't afford to buy? And unfortunately, well, I don't agree with this. Nevertheless, we see this happen every cycle. When people need things, they go take it when they can't afford it. And so here you're seeing all they're doing is validating what we know is the economy's under stress and headed into a crisis. And Macy's reported declining sales in June and warned that more shoppers are late on their credit card payments, again validating what Wells Fargo is saying. Delinquencies are viewed as a proxy for consumer health, and missed payments endanger a key source of revenue for the department store chain and a dangerous source for virtually every retailer out there, because how many people are paying on credit, buy now, pay later? Well, you'd be surprised, maybe more than you think. And Nike suffers record losing streak on China. And inventory woes, more problems here as the big shoe retailer has got too much inventory. And their weakness coincides with increasing signs of a soft consumer rebound in China, not to mention the U.S., which is a key growth market for the sports gear giant. And this is a problem because China's retail sales growth decelerated to 2.5% in July. And then now look at this. The U.S. consumer weakness erodes sales at LVMH, Unilever, and more. As signs of consumer caution grow as the Fed prepares to raise rates, potentially again as we look to see what Powell says tomorrow. The luxury goods powerhouse, soap maker, and tobacco company all emphasized weakness in the U.S. consumption when they reported earnings this week. Although their overall results were generally strong, American consumers have suddenly reined in purchases, especially with discretionary portion of their budgets. Now, we've been making this case for a while. The discretionary spending is going to come down. And now we have not just anecdotal evidence, we have actual evidence from these retailers that, look, indeed, we're seeing spending goes down. And this is what happens when you see total compensation start to slow down and fall against high consumer prices. And then you tack on the fact that people can't even make the payments on their credit cards. So as delinquencies go up, where is everything going to change from? It's the discretionary side of the spending equation. Not to mention, when student loan repayments begin, I think the economy is going to hit a wall. And demand is weakening after U.S. consumers ran through the savings they piled up while receiving pandemic support from the government in recent years. This from the Unilever CFO. The Dove soap maker is factoring in a mild U.S. recession, at least they're hoping, possibly at the end of 2023 or the start of next year. But of course, we know based on credit contractions, we know based on the cycles that this is going to be anything but mild. If we get away without having an all-out financial crisis, well, we should consider ourselves lucky. And if we look for signs of caution, well, the consumer is the best place to see it because sentiment is indeed dropping and consumers are starting to show signs of caution, he said. Private label growth has picked up across the market, but particularly in ice cream and dressing. But sentiment in the end is really all that matters because what comes next? If we continue to see a slowdown in discretionary spending, which I believe is the base case here, what we are eventually going to see is a rise in initial unemployment claims. And right now, I think we're kind of in the calm between the storm. We saw that initial wave. We're hearing from employers saying we really don't want to lay more people off unless it gets worse. And I think we're now only a matter of months away before we see the next big phase, if not sooner. And here you can see U.S. jobless claims dropped to 230,000, lowest in 3 weeks, giving some a breath of optimism that maybe the economy is about to turn around. And initial claims decreased by 10,000 to 230,000, and on an unadjusted basis, claims declined last week to around 198,000, the lowest since October. However, the drop was offset somewhat by the biggest jump in applications in Hawaii, without a surprise due to the devastating wildfires. But what does sentiment have to do with employment? Well, it has to do with it every way, because when sentiment goes down, spending goes down. When spending goes down, of course, layoffs go up. And here you can see on this chart, we've got the University of Michigan Consumer Sentiment Survey in blue against the 4-week moving average of initial claims. And you can note when sentiment is falling, claims are rising. You see it happen again here going into the 1990 recession. You can see it here happen again going into the dot-com bubble. Once again, into the global financial crisis, and now we saw sentiment fall, but due to all this pandemic stimulus, the economy held together. It's only a question now if we start to see sentiment roll over, and of course we'll keep an eye on that. We get those reports about every 2 weeks from the University of Michigan, not to mention the Conference Board, but if we see sentiment roll over and start to head down, well, that's our big indicator that the economy is headed into a crisis, and then it's only a matter of time before layoffs go up and delinquency rates continue to rise. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.